Hello, I'm Dr. Neil Blake. I'm Head of Research in UK and the EMEA region for CBRE. I'd like to take you through our new outlook for office markets in Europe and to give a little bit of the economic and political background to the drivers of the office market in Europe. The big news on the economic front is that we are seeing a sustained, if slow, economic recovery in Europe. It's not to say it's not stuttering, it's not at different speeds in different places, but it's actually happening. We've seen an upturn in economic sentiment ever since the end of 2012, continuing and strengthening through 2013. And now we're seeing economic growth figures which are backing that up. Practically every part of the Eurozone is now expanding. Some are expanding rather faster than others. There's still a gap between Southern Europe and Northern Europe. And for 2013 as a whole, Southern Europe will have seen a decline in the size of their economies, but it's stabilised and it's actually expanding now. It's very, very positive for property markets. If you actually look forward a little bit, what we see is continued recovery. 2014 should actually see expansion for Southern European economies, particularly for Spain and for Portugal, and this should be continuing to 2015. That said, the Eurozone countries are unlikely to be the fastest growing part of the European region. The fastest growing economies, or the fastest growing economy in 2013 actually turned out to be the UK, quite a surprise. It's nice to get a surprise on the upside in European economics. There's no reason that shouldn't continue and strengthen in 2014 and 2015. But we've also seen a resurgence in the Nordic economies as well, and they look set to produce above average growth over the next 3 to 5 years. And the other area worth mentioning, of course, is Central Europe. Poland has done quite well across the recession, but the Polish economy is now being joined by the Hungarian economy and increasing signs of recovery in the Czech economy as well as drivers of the Central European economy. So positive news all around. But behind that sort of positive sentiment and positive feeling to the figures, there have been a few doubts cropping up in 2014. It's maybe because the end of 2013 was so good, not just in property markets but for economic news as well, that people have highlighted a few negatives at the beginning of 2014. These range from things like weather-related doubts, the cold weather in North America, what would that do to the world economy? And we've actually had warm and wet weather in Europe, and there's similar questions about what that will do to the economy and how it will pan out. I mean, we think once the weather normalises, once we get into spring and summer, we'll see a bounce back and we'll actually see a catch-up for any lost output, so it won't make that much difference. But we've also had an emerging markets currency crisis, actually affected close to home as well. We've had a Turkish lira currency crisis. Interesting sign of unforeseen consequences. This was sparked off by the tapering of quantitative easing in the United States, just as shows what can happen in one part of the world as a result of something happening with another part of the world. That seems to have abated now. We've seen a devaluation of the lira, we've seen currency problems elsewhere in the world, but it's not turned out to be a generalised crisis. There's also been concern about China. Sometimes is China slowing down? What's happening to competitiveness? Is there a credit bubble? All sorts of questions increasingly about China. Well, one thing we can say about China is that China is changing. It's becoming a more balanced economy, and as that happens, there will be volatility, there will be ups and downs, there will be investor concerns. In the longer term, it's probably good for the West, but for now we'll see ups and downs as news items come out of China. But that seems to have dropped off the radar for the time being. The big thing that has replaced it in the news is what's been happening in Ukraine in recent weeks. The fall of the government, Russian intervention have all added to a climate of uncertainty and crisis in Ukraine, which has the potential to spread to other European markets. We don't think it will. It will certainly cause volatility, it will certainly cause problems in markets in the short term, should come back, but certainly something we can't avoid and something we need to watch. But overall, coming back to the economy, positives. Positive growth in North America, positive growth throughout Europe, Southern Europe moving into positive territory, some places actually doing rather well. Interesting in survey data, a number of countries appear to be growing at well above their long-term average. Now, we haven't seen that for quite a long time in Europe. This should all be quite positive when we look at the drivers of office demand in Europe. So, how does all this affect the outlook for rental growth in the European region? Well, there are two sides to analysing rental growth, of course, the supply side and the demand side. What we've really been talking about with the economic drivers is the demand side. And what's important there is how it translates into employment growth, particularly in the key service industries which drive the demand for offices across Europe. Well, interestingly, a lot of the key office drivers haven't had that bad a recession. We've actually seen growth in industries like TMT, professional services, back office services across the recession. It's only really the public sector which has shrunk heavily over that period. Of course, the financial services sector has had its problems too. But things haven't been that bad. Obviously, it's not been evenly distributed. We've seen big employment falls in places like Spain, Greece, other parts of Southern Europe. But we've seen expansion in Germany and in Poland in the UK. Now, going forward, obviously the question is this going to continue? Well, in a recovery phase, we have no reason to think things are going to slow down in those relatively successful markets. So we see continued buoyancy in the UK, Germany, Poland, etc. But the big thing that we think is going to happen, starting actually in 2014, is a turnaround in some of the southern European markets. Spain, as an economy, has stopped shrinking. It started to grow. Unemployment has levelled off. It's still high, but it's levelled off. But the conditions are there for employment growth to return. That could have quite a big impact on the office market. Elsewhere, we're seeing slower, less spectacular growth coming through, but still positives. The only country of concern at the moment is France. Seems to be having a bit of a growth pause, and we'd actually mark it out as the one which might not shine in 2014. So on the employment side, things are starting to pick up. Let's think about the other side. Let's think about the supply side. Now, we've got to root this actually deeper in historical context. During the boom years, we saw a massive expansion of supply in some cities, notably the southern European cities, but other parts of northern Europe too. What's happened with the slump is that a lot of that has disappeared. We've had very little new build in Madrid, in Barcelona, in Dublin, actually in London over the last 4 or 5 years. So we've actually seen the supply side actually correcting any market imbalances, actually helping to correct for the falls in employment we saw in some places. Not happened everywhere. Some places have actually seen continued growth in completions, notably the Nordic countries, not as big as the boom years, but still positive figures. And one that stands out in a big way is Warsaw. We've also almost seen as many completions across the recession we saw in the boom. So it's not the same picture everywhere, but the picture is very much a weakness of supply, actually a drying up of the spare capacity from the supply side in the market. Now, if you put that together with the demand side, it's actually the conditions where we see possibility of a rapid turnaround in rents. Now, the interesting city there where it's actually already happened is Dublin. Dublin actually saw rents increase by nearly 28% in 2013. Really that combination of no supply and renewed demand. We think 2014 is the year this is going to start to happen. Not quite as spectacularly, it will start to happen in Madrid and Barcelona. And over the next 5 years, we'd single out those cyclical recovery markets, as I think we describe them, as the area we might see the most rapid rental growth. In the core markets, well, the one that stands out, or the ones that stand out, are the London markets. We've seen relatively slow expansion of supply so far. We've seen exceptionally rapid economic growth, surprisingly positive economic growth across the recession. That's starting to spell out in rental growth, and there's no reason we won't see more of it, certainly in the next 1 to 2 years and beyond. What happens then will depend on how new supply reacts to the impetus given to it by rising rents. But obviously, nothing can actually happen in the future until we start building now. And there's no sign of a flood of supply in the London market. Elsewhere, Warsaw's boom on the demand side, boom on the supply side, very weak rental growth in the future. So the ones to watch really are those cyclical recovery markets and the London market for the next 5 years. Rental growth, of course, is only part of the picture. To actually think of the potential total returns to investors, we need to think what will happen to capital growth, so what will happen to yields. And of course, for total return, we need to think about the income you can get from your investment, which is vastly different depending on which part of Europe we look at the moment. So let's think about yields and how they might change in the future. Because at the moment we're seeing actually forces moving in different directions. As a result of economic recovery, bond yields, sovereign bond yields that is, have started to pick up. And in the long term we know that will put upward pressure on prime property yields. In the short term, however, that's not the only thing. It's probably certainly not the most important factor driving prime property yields. There are a number of things we can point out. One is the prospects of rental growth is a big attractor to investment. That's enough itself to push yields down in the short term. That's what we've always seen in the past when occupier markets have recovered. We're also seeing quite a weight of money coming into Europe. As financial confidence across the world actually rebuilds and resumes after the financial crash, we see that investors are very attracted to prime European property. It's bringing money in, it's helping to keep yields down. And it can also point to a general normalisation of financial conditions, the re-emergence of debt in Europe. They're all things actually helping to pull yields down in the short term. And we'd actually think there might be actually further falls in yields in all markets in Europe in 2014. Longer term, rather different. Longer term higher bond yields will tend to push up yields in the more expensive markets, in German cities, in London, in Paris. Not by a great deal, but certainly, they'll certainly limit the possibility of compression. But if we're looking at southern European markets, we're looking at central European markets, it's not the same market at all. The pressure is long-term yield compression, long-term downward movement, as long as the economies continue to recover, as long as we don't have major political upsets. So quite positive on that side. But the big potential for yield compression is not in the core markets. To complete the equation for the outlook for total return for investors, we need to think about the income side. Income returns for investors are very different in different European cities, and they can radically affect the desirability of investment in different places. At the moment, some parts of Europe are particularly expensive. Yields are low in places like London, German cities, Swiss cities, Paris, the Nordics. They all offer quite modest returns for investors. Doesn't mean they're not investing there, but obviously they're driven by other factors. We actually still get quite reasonable returns in some of those cyclical recovery markets. And that's the one thing that's actually not that different from the rental growth story to the total return story. The league table is still very much headed by places like Madrid and Barcelona and Dublin. They're combining not just high rental growth, potential for future yield compression, and a relatively high income return if you can lock yourself into it now. And that's a very, very different picture to what we might see in the core markets. The core markets have, in some cases, London for example, got potential for rental growth. Potential for capital growth is muted by the fact that yields can't compress that much more, or certainly won't compress much more in the medium term. Same thing goes for the German cities too, with a rather more modest rental growth. And you add to that quite weak income returns, and you actually get quite modest total returns too. So you get quite a different looking league table in some ways. London is actually at the bottom, towards the bottom of the total returns league table. Places like Warsaw, which have got very weak rents, actually offer quite good total returns. So it's not just Madrid, it's the Central European markets come into play as well, because of potential for yield compression, because of the high income returns that are on offer. So quite a different picture. But the story there is, why is this happening? Why shouldn't all investors just go to Madrid? Why shouldn't they just go to Dublin if there's anything left to buy in Dublin? Why shouldn't they be Barcelona? Why should they bother with London or Munich or Frankfurt? Well, of course, there's an offset from risk for every return that's on offer. Those markets in southern Europe, which are offering quite good total returns, have a certain amount of risk still attached to them. When we talk about economic turnaround in places like Madrid or Barcelona, we're talking about forecast turnaround, something that hasn't actually happened yet. We're very positive about these economies, but until we actually see the signs that economic growth has set in, there's that level of uncertainty which we can't get away from. Now, if you compare that to somewhere like London, which has grown quite strongly in the last 5 years, not just what's expected to happen in the next 5 years, it's a very, very different picture. We know there's a reliable bedrock of occupier growth in London that just isn't there yet in Madrid. You could say the same thing for the German cities and the Nordics too. You buy into those core northern markets, you're buying into a proven track record of economic growth which leads to occupier demand. The other factor, of course, is liquidity. Big issues in southern European markets in the last few years. One of the reasons investors, particularly cross-border investors, are attracted to London and German cities. So all of that balances out the higher total returns which are potentially on offer. But certainly as far as the raw figures go, high total returns in Dublin, in Madrid, in Barcelona, in Warsaw, in Prague, maybe in Budapest, maybe in places like Milan as well, starting to show up on the figures as well. If you're willing to take a gamble, there are a lot of potential cities actually showing up on the radar which have not been there for many years.